Hey there and welcome to the channel. In today's video, we're going to be doing something a little bit different than what I usually do, which is to analyze individual companies. We are going to be doing a guide on how to invest in the stock market for beginners. Now, the reason I'm doing this video is because I do get asked a lot about the best way to start investing in the stock market, and I'm always telling people the same things. So I decided to do this video so the next time I get asked about the best way to start, I can just point them out to this video. I decided to have the video in two parts, mainly because there was a lot of information that I wanted to convey to new investors. But I will put the chapters into the video, so you will be able to skip between different parts if there's something that you have already learned. Now, this is a video that I wished that I would have seen 5 years ago when I started investing in the stock market. That would have saved me a lot of time and probably a lot of money as well. So hopefully this video will be of some value to you. And I do want to ask you, if you do get any value out of it, to smash the like button and subscribe to the channel if you haven't already. So let's get started. And the first thing is, who is this video for? Well, it's basically for anyone who is interested in learning about the stock market. And it doesn't matter if you have any prior knowledge or experience. This guide should help you understand the basics of investing in the stock market and the best way to get started. Even if you've done some investing before, this guide should have some helpful pointers for you to help you master the craft. Unfortunately, this guy won't be teaching in this video, but we will be using the methods that he teaches in his annual letters to shareholders, Berkshire Hathaway meetings, and the numerous interviews and articles that I've read throughout the years. So what are we going to be talking about in this video? Well, the first thing is to try to understand what the stock market is, and then we're going to look at why we would invest in the stock market and not pick something else. We will then go through some basic concepts of investing, the power of compound interest and the rule of 72. We'll try to understand why it's important to start early and why market timing doesn't work. I will then give you some pointers on where to get the resources for learning and which great investors you should study. We will then touch a little bit on avoiding scammers and the very important psychology of money. But the psychology of money is something that everybody should study, in my opinion, regardless if you want to invest or not. We will then talk a little bit about investing in ETFs, but this video is really for people who want to be able to pick individual stocks. But the strategy of passive investing and investing in ETFs or index funds is a really sound investment strategy. And that is something that most people should do. In fact, Warren Buffett has said that 99% of people should invest in ETFs or index funds. And Warren has no reason to lie. We're then going to talk a little bit about accounting, which is the language of business. We will then go through my investment strategy and take an example of an actual company that I own in my portfolio, just to try to give you a little bit of sense of how I research companies. We will then talk about a very important concept in investing, which is the margin of safety, and then end the video by discussing how much to invest. So what is the stock market? Well, the official explanation of the stock market is a place where shares of publicly traded companies are bought and sold. It helps companies to grow by allowing them to raise funds where they sell their ownership in the company to investors. And investors can then buy and sell these shares and try to make profits as the company grows and becomes more valuable over time. I think most people understand this explanation, but I want to show you how to really think about the stock market, which is something that I think will give you an edge if you are able to think about the stock market in the same way that Warren Buffett does. But Warren thinks about the stock market like Benjamin Graham wrote in The Intelligent Investor, which is chapter 8. And Warren has mentioned that chapter 8 and chapter 20 are probably the most important chapters ever written on investing. In chapter 8, Graham introduces the concept of Mr. Market, which is a hypothetical character who offers to buy or sell stocks every day at different prices. And his moods can be erratic and emotional, which leads to fluctuation in stock prices. And according to Warren Buffett and Benjamin Graham, we should think about stocks like somebody who was buying a private business, and we are training ourselves to think about what the business would be selling at in a private transaction. You can imagine if you were buying a small restaurant in your local town, the first thing you would probably be thinking about would not be the price of the restaurant. You would think about How many customers do you have? Are the customers happy with the service? Is it always full? Are you getting good profits? Does the restaurant owe a lot of money? First and foremost, you think about these things, which are fundamental things that you need to have a great business. Most people in the stock market are controlled by the price changes. They let the stock market dictate what the actual price of the business should be. But Graham emphasizes that investors should view the market as a tool or servant, but not as a guide. And instead of being influenced by market fluctuations, investors should use them to their advantage. And in chapter 8, Graham taught us that in the short term, the market is a voting machine. Now, what does he mean by that? He means that stock prices are not affected by the intrinsic value of the company. They are affected by macro events like wars and news and stuff like that. But if you look to the long term, the stock market is a weighing machine where it weighs the company's fundamentals, and based on the fundamentals of the company, it values the business, just like you would if you were buying a small restaurant. So we have to be able to distinguish between stock prices and intrinsic value. Like we saw in the picture earlier, stock prices are influenced by market sentiment and can be irrational, while intrinsic value is the true worth of a company based on fundamentals. Now, of course, market prices will fluctuate, and as an investor, you should expect this as a normal part of being in the market. But wise investors use these fluctuations to buy when prices are low and sell when they are high. But the best scenarios is when we can buy when prices are low and hold forever. Now, like the late Charlie Munger said, if you can't stomach a 50% drop in your portfolio, you really shouldn't be in the markets. And that is something that you have to accept if you are going to be investing in individual stocks. It's going to be really volatile, and you have to be prepared to hold on for a bumpy ride. Now, here we can see the intrinsic value of the company is the blue line, or the true value of the company, while the green line is the market price. And as time goes by, the company becomes more and more valuable. It's increasing its intrinsic value. And the stock price doesn't always follow the intrinsic value. And as we can see here, the stock has become really overpriced, where the market price is much higher than the intrinsic value. And as time goes by, this will correct itself. And by this point in time, the intrinsic value and the market price are the same. And here we can see the stock price has continued to go down. And now the stock is underpriced compared to the intrinsic value of the company, which should give the intelligent investor an opportunity to buy in at a good price. And Graham also stresses the importance of long-term investing, where investors are focusing on the underlying value of the companies they invest in rather than short-term market movements, like we've been talking about. This is a comparison between Berkshire Hathaway and the S&P 500 index for 30 years, where Berkshire Hathaway has produced 5 times the return of the S&P. But of course, normal investors like you and me cannot expect the same returns as Berkshire Hathaway. But if we use the same methods that Warren Buffett has been using and teaching for the last couple of decades, we should be able to do pretty well. Now, in his book, Benjamin Graham and Buffett, for that matter, they are really clear on the distinction between speculation and investment. But speculation is when you are betting on something happening in the short term, while investment is based on a thorough analysis of a company's fundamentals. And here we can see a comparison of investment and speculation, where you have differences in the time horizon, the level of risk, the investor attitude, and the decision criteria, where investors always have a long-term horizon when they are investing. And by long term, we're talking about 5, 10, 20 years. While speculators are looking at a much shorter amount of time, and it is much riskier to be a speculator than an investor, because as an investor, you're always taking calculated risks, which should work out fine in the long term. And the intelligent investor is more cautious and conservative than the speculator, and the speculator is trying to get an edge based on some kind of technical charts, market psychology, and the opinion of various news outlets. While, like I've said before, the investor is basing his decisions on fundamentals and the intrinsic values of companies. And the investor is usually investing in something like the stock market or real estate, bonds, stuff like that, while the speculator is speculating in foreign currencies and crypto and other similar things. Now, why would we choose to invest in the stock market? Why wouldn't we just invest in real estate or YOLO into some kind of new crypto? Historically, over a very long period, The stock market has provided higher average returns if you compare it to the traditional investment options, like bonds, for example. And Warren Buffett has a good saying about what the stock market is. It is really designed to transfer money from the active to the patient. And that is something that I'm trying to teach with this video, is to try to be patient and to be able to take advantage of the various opportunities that the market offers to us on a regular basis. If you compare the real returns of various asset classes, which real returns are basically adjusted for inflation, we are looking at a period of over 200 years where stocks returned 6.7% on average, bonds 3.5%, and treasury bills 2.7, and gold was almost flat at 0.6%, while the dollar has, of course, lost its purchasing power. Now, of course, because this happened in the past, it doesn't guarantee that it's going to happen in the future. But in my opinion, this trend that has been going on for the last 200 years is very likely to continue into the future. Now, liquidity is something that is mentioned as a good thing when you're investing in stocks, but it really can be a double-edged sword, because if you're not able to do like Benjamin Graham tells you and make the market your servant and not your master, you will have problems when the stock market starts to crash and your investments are really liquid and therefore really easy to sell. And that is a mistake a lot of beginners make in the stock market. And even some very experienced investors do that also by selling out at the bottom. And a lot of the times they are selling stocks just because the stock price is low. Nothing has really happened to the business, but it really takes a strong stomach and you have to know what you're doing to be able to hold on to stocks while the world is going to hell in a handbasket. Now, like we saw in the earlier graph, stocks have historically outpaced inflation, so they are a good inflation hedge, which helps us preserve the purchasing power over the long term. Now, if we compare home prices to stock prices since 1989, we can see that stock prices have outperformed home prices by a decent margin. And these prices are, of course, home prices. They're not commercial real estate. And I'm not saying that you can't do really well by investing in real estate. I personally invest in real estate along with my stock picking. I'm just trying to show you the reasons why I think that everybody should be invested in the stock market to some extent. Whether you decide to go the ETF index fund passive way, or if you are interested in picking individual stocks. And this is a very simple picture that really shows you how the stock market works, where in the short term, the price of the stock is determined mostly by sentiment and has very little to do with earnings. Then, as time goes by, the sentiment gets less and less important, and the earnings are all that matters when the market is valuating the company. Next up, we're going to talk about a fundamental concept in finance and investing, and really in life, which is the power of compound interest. But Albert Einstein said that compound interest is the eighth wonder of the world. He who understands it earns it, he who doesn't pays it. And compound interest is basically where you have interest earned on both the principal amount and any interest already earned. And this means that over time, your investments are growing exponentially. And as humans, we are wired to think linearly. So it's pretty difficult for us to think exponentially. That's why it's hard for human cognition to grasp the concept of compound interest. And you probably heard this question before: would you rather have $1 million or a penny doubled for 30 days? And the answer to that question really shows you how powerful compound interests are. And if the penny is doubling every day, you have 1 cent the first day, 2 cents the second day, and 4 cents the third day. And it keeps on doubling throughout the month. And even by day 27, you're still below the $1 million you were offered in the beginning. But when it comes to day 30, you're up to 5.3 million, which shows us how powerful compounding really is. And another concept that's related to compound interest is the rule of 72. But as investors, we're always trying to figure out how fast we can double our money. And the rule of 72 is a quick and easy way to get a rough estimate of the time it will take for us to double our money without having to do some kind of complex calculations. And for example, if we know we get a 10% return on our money, we just take 72 and divide by 10, And that gives us 7, which is the time that takes the investment to double. And as you start to invest more, this thing really becomes second nature to you, where you don't have to do any calculation. You just remember if you have a 10% return on your money, then it takes you 7 years to double the investment. And if you have a 15% return on your money, it takes 5 years. And here we can see a table where the rate of return is from 1% up to 10%. And that really shows us how slow a 1% rate of return is, where it would take you 72 years to double your money. And you can, of course, turn this formula around. If, for example, you would know that it's going to take you 12 years to double your money, you would just divide 72 by 12 and know that the rate of return you're getting is 6%. Next up, we're going to touch a little bit on the importance of starting early. And of course, the earlier you start to invest, the more compound interest will help you. This can be a really significant difference over the long term. And it can also help you with risk tolerance, because if you're starting early, it gives you more time to recover if you had any losses. And I can just tell you right now, if you're going to be investing in individual stocks, you are going to lose money. Everybody does. It doesn't matter how good you are. And if you are a young investor, you have longer time to invest, and therefore you can afford to take on a little bit more risk. Also, you are usually dealing with lower sums of money, which means that it's not the end of the world if you lose that money. It's probably a more valuable lesson for you down the line. This guy was probably not investing when this picture was taken, but he did start really early, or back in 1942 at the age of 12. And he has been investing ever since for over 80 years. Now, if you're already 30, 40, or 50 years old, you could be thinking to yourself that it's too late to start to invest now. But this Chinese proverb should give you the answer, where the best time to plant a tree was 20 years ago, and the second best time is now. And of course, with investing, you are building something up for the long term, which is similar to planting a tree. So it really doesn't matter at which age you are, you should really be thinking about the future and preparing for it. And there is no better way, in my opinion, than to invest. Next up is a really popular pastime of Wall Street and other speculators that are using market timing to try to buy and sell stocks based on predictions of future market movements. And a lot of people try this to maximize their profits, but it is a really difficult and risky strategy that is very often unsuccessful. And this is a quote that I love from Terry Smith, which is a British investor that is often called the Warren Buffett of the UK, where he talks about there only being two types of people when it comes to market timing: people who can't do it, and people who haven't realized that they can't do it. And he is absolutely correct. So my advice to you is not to even try market timing. You're not going to be successful with it. I can promise you that. And since we are talking about market timing, this chart is really interesting, which was made by JP Morgan Asset Management, where we can see the performance of $10,000 invested in the S&P 500 between 1995 and 2014. So this is a pretty long period of 20 years, where we can see that if you were fully invested the whole time, you got a 9.8% return on your money and turned $10,000 into $65,000, which is pretty good. But if you only missed 10 of the best days in those 20 years, your returns would be much lower, or 6% per year, and your $10,000 would be $32,000. And if you missed 60 of the best days, your return would actually be negative 3%, and would turn your $10,000 into $4,000 after 20 years of investing. And that is safe to say that would be rather disappointing. And this is also interesting that 6 of the 10 best days occurred within 2 weeks of the 10 worst days. Next up, we're going to discuss the learning resources, which is super important because you have to know where to get the information from. Because there are a lot of people, especially in the financial markets, that are feeding you information that will definitely not help you in the long term. So if we start by looking at the books that I would recommend, if you haven't read any financial books and you are a total beginner, I would start with books like The Psychology of Money and Rich Dad Poor Dad and The Richest Man in Babylon. Those books will give you insights on how you should really think about money and will teach you the basics like the difference between an asset and a liability. Now, once you read through those, you could start with a book like The Simple Path to Wealth by J.L. Collins, where he explains how you can get wealthy over the long term by investing in ETFs and index funds. But if you think it's more exciting and more suitable to your character to pick individual stocks, then I'd recommend starting with a book like Rule 1 by Phil Town and One Up on Wall Street by Peter Lynch. And once you have learned the basics, you can move on to books like The Warren Buffett Way by Robert Hagstrom, Investing for Growth by Terry Smith, and The Essays of Warren Buffett. The next book that I recommend is Poor Charlie's Almanac, which is my favorite book, but I would say that is a book for people who are a little bit advanced. So I would never recommend starting with that one, but it's definitely a must read for everybody who wants to get good at investing. And then finally, we have Margin of Safety by Seth Klarman, which is a really good book on how to think about this very important concept that is margin of safety, which we will get into later in the video. Now, the next resource is YouTube, which I've used quite a lot for the last couple of years. And there are many YouTube channels that provide really valuable content on investing. However, it is important to be really cautious of all the scammers. There are all kinds of programs on how to get rich quick using the stock market. And my advice to you would be if you see someone pitching an idea about getting rich quick through the stock market, I would run away instantly. Because if you study all the best investors, which is something that we are doing in this video, you can see that they all made their investments over a very long time period. And I've personally gotten burned by following some bad advice that I got on YouTube. Now, all of these channels that I list here are channels that I have been watching for a couple of years, which are reliable. And the first one is Investing with Tom. Tom is a value investor from New Zealand. And the next one is called The Plain Bagel, which is a great investment channel for people starting out in the stock market. Then you have the stock compounder Brad Kellner, which I would say would be for someone who's a little bit advanced, not for the total newbie. Then you have the Swedish investor, which is also really good for beginners. Hamish Hodder is someone that is also good at teaching beginners. And then you have value investing with Sven Carlin, which again is a little bit on the advanced side. Now, Monish Pabrai and Guy Spear are two professional investors that have their own YouTube channel, and they provide a lot of valuable content there. So I would advise checking that out, even if you are a total beginner. And if you like listening to podcasts, I would advise starting on the podcast We Study Billionaires. They have really good podcasts which will help you get started. And Business Breakdowns is another great podcast, which if you are thinking about investing in a certain company, you might be able to find more information on the company on Business Breakdowns. The last podcast that we have, which is my favorite, is Focused Compounding. And they also have a YouTube channel which provides a lot of valuable content. Now, I would not say that focused compounding is for the total beginner, but once you get a grasp of the fundamentals of investing, and maybe you've already started your investment journey, I would start listening to the Focused Compounding podcast as soon as possible. Now, the next learning resource, which is very important, where I have learned a lot, is to study great investors. And for some reason, the best value investors are also fantastic writers. Warren Buffett has the most famous shareholders letters, and you can read all of them for free online. And I'll show you where in a couple of seconds. In the letters, he talks about long-term investing, patience, and compound growth. And Warren Buffett is really a master teacher where he's able to simplify complex financial concepts for all audiences. And his focus is, of course, on value investing, where he emphasizes the importance of investing in businesses that have competitive advantages and to buy them at a reasonable price. And his letters are really fun to read, where it really shows his personal touch. And you can see that he has a great sense of humor. In the letters, he doesn't just talk about financials, he's also addressing corporate governance, management, and economic trends. And if you go to this website here, danielmnke.com, you can find all of Warren Buffett's public writings and all of his shareholders' letters. and you can read them there all for free. And if you go to investing resources and scroll down to investing and letters, you can find all publicly available writings of Warren Buffett. Now, this document here is massive, and the guy who owns the site is still adding to it. It's currently 4,953 pages, and I would recommend 100% to read through all of them, because I don't think even if you would study finance and business for 5 years at a university, you wouldn't get a better education than reading through these letters. I will leave a link to the website down in the description. But next up we have my main man Charles Thomas Munger, which unfortunately recently passed away. Charlie Munger was Warren Buffett's right-hand man, and his writing and speeches, we already talked about his book, Poor Charlie's Almanac, but he is known for his wit and wisdom and really insightful commentary on investing, business, and just life in general. And on the website, you can also read a lot of material from Charlie Munger, and I would 100% recommend reading that as well. Next up, we have Peter Lynch, which wrote the book One Up on Wall Street, which is recommended for beginners. And he also has his letters on the website. Peter Lynch is an absolute legend in the game of investing, where he delivered 29% annualized returns when he was running the Fidelity Magellan Fund. Peter Lynch is known for his method of investing in what you know, and again with him I would recommend reading everything you can get your hands on by Peter Lynch. Terry Smith is another master of the stock market, but he is based in the UK and is the founder and CEO of Fundsmith. And I would say that my personal investment style probably resembles Terry Smith the most, where he focuses on quality companies with sustainable business models. And Terry has really achieved impressive returns for his investors, where he has achieved a 15% compounded annual growth rate since starting Fundsmith in 2010. I recommended the book that Terry wrote, which is Investing for Growth, and he also has his letters on the same website. Next investor that we have is Francois Rochon. I'm probably mispronouncing that, but he is the founder and manager of Giverny Capital, which is based out of Montreal in Canada. His value investing strategy is really similar to Warren Buffett, and Francois has achieved a really impressive 30-year, 15% compounded annual growth rate. And I guarantee you, if you're able to achieve a 30-year, 15% compounded annual growth rate, you will become very rich. I have also read through all of his Giverny capital letters to shareholders, and they are all on the website that we looked at earlier. They are filled with very valuable insights, and I picked up a couple of the strategies that he was talking about in his letters. Next up, we have Nick Sleep, which is actually retired as a money manager, but he only manages money today for his charity fund. Nick Sleep ran a fund called the Nomad Fund, and he is known for his long-term investment approach, where he focuses on quality companies with strong competitive advantages. And when Nick was closing down the Nomad Fund, they only had 3 companies left in the fund, which were Berkshire Hathaway, Amazon, and Costco. Now, between 2001 and 2013, he was able to achieve an annual return of 20.8%, compared to about 6% performance for the market. So he outperformed the market by 14%, which is really amazing. You can read all of his letters on the website. I've done that personally twice and learned a lot from him. And the final investor that I want you to study is Seth Klarman, which wrote the book that I mentioned, Margin of Safety. Seth Klarman is a hedge fund manager, and he founded the Baupost Group, which is a private investment partnership. And I believe the partnership is closed for new money, so you won't be able to invest with him even if you wanted to. Klarman is a really value-oriented investor, and he has a strict focus on risk management, which is the reason he's been able to provide excellent returns to his investors. Now, his book, Margin of Safety, is really expensive and hard to get, but you can get a free PDF version online And you can also read his letters on the website. Now, I just want to show you real quickly a website where you can go and see where these great investors are investing. It is called dataroma.com. And for example, if we choose Warren Buffett here, we can see that Warren Buffett has a $313 billion portfolio and 45 stocks in his portfolio, where Apple is his biggest holding, or 50% of his portfolio, and his stake in Apple is valued at 156 billion. You can then scroll through his portfolio and see where he's been reducing his stakes in which companies. And you can also see if he's been buying into new companies like Liberty Media Corporation. You can then go to activity and see the history of what Warren Buffett has been buying and selling for the past couple of years. Now, I would recommend following all of these investors and try to see for yourself what they are buying and selling. I personally track about 20 investors every quarter to monitor their activity and try to learn which businesses they are buying and selling. And you can see a video on my channel that I made recently about what these super investors are investing in.